Testing 1 2. Testing 1 2. Hello. Welcome to another live stream where I mess up sharing the screen on a regular basis. Am I coming through loud and clear? Wonderful. See some familiar names. Let me just share the link to this in CGM and OCA. That's better. And I'll be honest, I don't know why it freezes sometimes. I can't control things. I also don't know why my new webcam is so dark. But hey, I'm actually I'm upgrading the setup next week, so hopefully the lighting will be far better going forward. New Orleans. Where else are people dialing in from as if we're still on telephones? Birmingham, Alabama. I almost went to university in Birmingham, England. York County, Pennsylvania. Dallas, Texas. San Diego, California. Big up my Abbotsford, Vancouver, Port Charlotte, Florida, Tucson, Arizona, Durango. That's a great place name. Durango, Colorado. Sounds Australian, doesn't it? Durango. This is like when I had to do the first cache deep dive in CGM and I had to pronounce that word. Daniel, good to see you, my friend. We had a lovely chat the other day. And there's a few things we're going to cover today. First things first, Lululemon, which is a stock that quite a few people have asked me to look at. So I'll offer my thoughts there. Going to talk through a bit of consumer weakness. The health of the consumer, specifically the US consumer, is debatable. So I'm going to talk through some things there. Talk through a bit of stuff we're doing in 2026. Very exciting. And really anything else anyone wants to see. So we'll get going. Give me a 1 in the chat if you own or have owned Lululemon. And a 2 if you have not. And a 3 if you're thinking about it. Mix of 1s and 2s. I see Paul in the chat. Paul, I sent you an email. We were supposed to speak the other day, but I didn't see you on the call. So just reply to that email, letting me know everything's okay. And then we can always reschedule. But yeah, Lululemon, it's been a tough one. Can everyone see the screen, by the way? Last time we did this, there was a black screen. so Lululemon, it's been a rough year. We're down 51% on the year. We're down, at peak to trough, we were down almost 60% from the highs which we saw at the beginning of February. We're currently market cap 22 billion, trading at 12 to 15 times earnings, which on the surface seems quite cheap. But I don't think this is the absolute knockout bargain that some people do. And there's a few reasons for that. So first things first, I want to talk about the good. The good is the company is still growing. Top line last quarter was up about 7%. Earnings was up a little bit as well. The cash position's pretty good. They're sitting on about 1.2 billion in cash. But a lot of that is backwards looking. Where the concern is for the stock is forward looking. And there's a few things that have hit these guys pretty hard. The latest earnings was rubbish. And by the latest earnings, I mean 3 months ago, because if you see on here, they've actually got earnings today. So I'm recording this at 11:30 a.m. Eastern. They're reporting the latest quarter's earnings after the market closes, so in about 5 hours' time. I'd be really interested to see if the guidance has changed, because the guidance last quarter was terrible. They were talking about 3% top line growth. 3%. That is inflation level. So you're basically at net zero. And part of this is tariff related. There's a pretty decent, if we look here, there's one number here that really stands out to me. And if I go on a quarterly basis, actually, and it's this number here. You see, this was actually improving, peaked at about 60% in Q4 of 2025. And they're reporting more expected gross margin contractions. Now, this was a company that traditionally, for an apparel company, had really good gross margins because they were selling premium clothing. They were selling athletic clothing where you're spending $150 for a hoodie, $120 for leggings, which at the time was pretty unheard of. You didn't pay $120 for leggings. What are you talking about? But Lululemon, they got a target customer base and they got people to pay for those leggings. However, that was 2016. And they had a really good run. 2016, 17, 18, 19, 20, 21. Really good run. However, in this time period, competition has emerged. Lululemon is now not the only company that is in the premium athleisure segment. And even though the overall segment has grown, the competition has intensified. So we have brands like Alo, which is private, who have a very similar price point to Lululemon. So this is not the sort of premium brand positioning anymore. They've gone from a category of one to a category of many. And even though they're probably still the most recognizable name in that category, that doesn't mean as much as it used to. The other concerning metric for me is this trend here, the inventory trend. You see, that's steadily creeping up. And when inventory creeps up and revenue doesn't grow proportionally, that says to me, okay, there's less and less throughput. And the overall demand level is tapering off when compared to expectations. Because Q3 is traditionally sort of the higher inventory quarter because you're getting stuff in ready for Q4. But if we compare the Q2 numbers, we had 1.4 billion in inventory in Q2 25, and in Q2 26, which was the latest quarter, it was 1.7 billion, even though the revenue growth was only 7% year over year. So revenue's growing at 7%, but inventory is growing at 20%, which is not a good sign. So it ain't the knockout that people think, but depending on what happens this quarter, we have to wait and see whether the reversal is actually in or not. Because right now, this is a falling knife, and I don't like trying to catch them. Because, you look at the chart and you think, okay, it's down 50%, can't get any worse. Speaking from experience, yes, it can. A stock down 75% is a stock that's gone down 50% and then gone down 50% again. And one thing I think people get really hung up on is like when we look at the PE ratio, for example, people see forward PE of 15 and they think, okay, that's really cheap. Historically, the stock's trading at a multiple of anywhere between 30 and 40 times earnings. All it has to do is re-rate to that and you get an easy double. Nothing else has to change. But the problem with that assumption is you're assuming the E continues to increase. The E can also go down. Great example of this, Nike. Nike is down 50% in the past 5 years. The PE ratio hasn't changed. It was trading at about 35 times earnings 5 years ago. It's trading at 35 times earnings today. If you're wondering how that's possible when the stock's down 50%, it's because earnings are also down 50%. Give me a 6 in the chat if that makes sense. So one really important thing to understand is earnings is not up and to the right indefinitely. And just because a stock has a low PE ratio does not mean it is dirt cheap. In fact, a lot of the time, a low PE ratio is indicative of real problems. Not always, but a lot of the time it is. So if you're looking at Lululemon thinking, what do I do here? Well, answer number one is you don't do anything for the next 5 hours. You wait until earnings is in, because that's going to give us a lot more clarity on, is this a continued decline or is the worst over? I know what you're thinking, but the stock might be a bit, if it's good news, the stock's going to be 10% higher tomorrow. And yeah, that's quite likely the case. But you've got to think about it in terms of, what information do I have that allows me to have this level of conviction? So if the stock is 10% higher, but my level of conviction is up 20%, that this is a better company and this is a better investment, that's good. I would rather pay more with the higher level of conviction. Because that's another problem we get into as investors. We think we've always got to get the lowest possible price. And it really doesn't work like that. Because sometimes the market is wrong. Sometimes you just miss out. And more importantly, there's always more than one opportunity. Take a company like Nvidia, for example. You could have really bought Nvidia at any time in the past decade, and it would have been a good decision. But there are certain times when the stock looked cheap. There were certain times when the stock looked pretty expensive. But it's like, even if you missed out on the first few years, you still would have had a great run afterwards. Like, I didn't take a position in Tesla until 2022. I missed out on all that run up in 2019 and 2020. Did that stop me from buying in 2022? No, it didn't. Daniel says, how much institutional ownership? Well, let's take a look-see, shall we? We got 74%. We can probably find out who the biggest holders are as well. You used to be able to see this on stock analysis. You used to be able to see the biggest funds, which was very useful. Apparently not anymore. The other thing I want to just highlight is this section here, KPIs. This is a very useful way of gauging what's going on. And you see here, US revenue is basically flat. Canada revenue, basically flat. The only growth is China and a bit of non-US. China's the only growth market. So in the short term, betting on Lululemon is a bet on China or the health of the Chinese consumer. Because the US one ain't reversing anytime soon. So I think there's a lot better out there than Lululemon particularly. Because, well, we need to talk about the health of the US consumer. So Black Friday's been and gone. And we had companies reporting 9% increase in sales year over year. Black Friday promotions, which, is pretty decent, pretty good. But there was also a statistic that really scared me, which was buy now, pay later use was up 45% year over year. Now, buy now, pay later. So that's companies like Affirm, Klarna, Afterpay, which is now owned by Square, which became Block. This is not a particularly good sign for the health of the US consumer, because the typical buy now, pay later user is what you would see as like the low to middle part of the market. People who perhaps have tapped out their existing access to credit, and now they've sort of gone from the normal credit providers to one step below, which is these buy now, pay later companies. So your Klarnas, your Affirms. And interestingly enough, Klarna actually launched a new product recently called Fair Financing. If you're wondering what fair financing is, it's a credit product. It's not zero interest. It's an interest-bearing credit product, and this is up 244% year. So they call it fair financing. It's loans. So people who can't traditionally get loans from your credit card companies or your bank are getting loans from Klarna to buy stuff. And, this is not home renovations. This is not auto loans. This is loans to buy stuff, most of which would probably not be considered essentials. Although worryingly so, the use rate of Klarna to get essentials such as groceries is also increasing, which is kind of terrifying. These guys can talk about democratizing finance as much as they want. If these companies are growing, it does not fill me with hope for the overall health of the US consumer, the person on the street, so to speak. I think they have an example here of how this fair financing stuff works. Or maybe it was in a different presentation. No, it's not in here. But it's statistics like this: 32% up year over year. Active customers, so customers who have an active Klarna, they don't call them loans, but they're a loan. 114 million. It's a lot of people. And this is not the only statistic. As John says, you can pay your Chipotle bill in 4 interest-free installments over 6 weeks. Daniel says, I believe you also need to look at the US consumer segmented by the top 10% and everyone else. I think that's a very good way of looking at it. But the interesting thing is, it's like, this is not necessarily a total stock market wide contagion event like it would have been perhaps 20 or 30 years ago, because the top companies, the companies at the top of the index are Nvidia, Microsoft, Google, that don't necessarily depend on the health of the consumer. Some of them do more than others, but Nvidia certainly doesn't anymore. But I think consumer discretionary as a segment is potentially in for a pretty rough 18 to 24 months, because the US consumer is getting more and more stretched. Another statistic I found was the auto loan delinquency rates, which is once again another pretty good indicator of the overall health of the economy. Where was it? I had a tab up. I've got too many tabs. That's the problem. Here we go. So US auto loans delinquent by 90 or more days. We're at 5% now, which is the highest since COVID times. I said the C word. Does that mean I'm going to get in trouble on the YouTubes? Who cares, man? I mean, if we compare it to 2015, 2016, 2017, obviously this was a very unique period in history. So maybe not a one-for-one comparison, but it's creeping up. Not a good sign. Nothing on the screen. The screen is blank. Why do I bother with this stuff? Why do I bother? Is that better? Don't know why I bother, man. There we go. Back in the game. Here we go. US auto loans, delinquency rates. 5% right now. Up from 4% a couple of years ago. Long-term average, 3.5%. People are getting 7-year car loans now. That is not good. Elaine said, I just heard, no, we're not doing 8, are we? 8 years? Goodness me. At this rate, people are paying, people will probably be paying more in interest than the value of the car. Not even including the principal, they'll be paying more in interest. They'll be paying for the car twice. This is not good. I am very, very skeptical of the consumer discretionary segment. Enterprise, nah, that's fine. Not really too worried about enterprise, but consumer, it's worrying. So like these companies like Klarna, Affirm, I'd never invest in them. It's like they're taking on credit risk, but because of the way they structure their business, like they're not considered as like lending companies, but they are. And obviously far smarter people than me run them, but that doesn't necessarily mean they can't make mistakes. We had funds like long-term capital management run by some of the smartest minds in the world, and that blew up because they miscalculated how different interest rates were going to play out. And I also don't think we're ever going to get a reversion to like a zero interest environment ever again. As much as certain people may want it, I think interest rates long term, and by long term I probably mean medium term, will stabilize around 3.25%. Which is fine. That's still a relatively low interest rate environment. Can you hear my daughter, by the way? Oh, you can. That's fun. She's been having fun today. Don't, you made me. That's good. I always forget because I usually do these on Zoom, and Zoom has like a very good automatic noise cancelling function, but other platforms don't have it. So I forget that you can hear other stuff. That is a lot of fun though. Oh, I love that child. Anyway, where was I? Oh yes, the health of the US consumer. It's worrying. It really is. But does everyone understand when I say like this is not necessarily the straw that breaks the camel's back? Give me a one in the chat if that makes sense. Just because the companies at the top of the index, a lot of them are divorced from this. Ivy definitely thinks the loan delinquency rate is unacceptable. Another subject I wanted to cover, because a few people have asked me about this, these like really high quality businesses that haven't really done anything in the past year or two. So probably the best example of this is Costco. Flat year to date, 1 year down 11%. Let me get the 3-year chart up. 3 years is pretty good. Let's actually just get the stock price return though. 3 years, okay, so really, really good run. And then so about 15 months now, it's been flat. I need to switch tabs, don't I? Are we good? Can we see the Costco? So we're down 11% on the year. And the issue is, I love Costco. As a consumer, love it. As a business, love it. As a stock, don't love it. The problem is, a stock gets to the point where no matter how you look at it, it's pricey. Costco today trades at 43 times next year's earnings. I cannot justify paying 43 times earnings for Costco. I can't. No matter how good the business is, because it's not a growth business. It is a consistent compounder, but it's not going to compound at the level that justifies me paying 43 times earnings for it. Like, what are we looking at here? Revenue growth, 8%. What's earnings growth? 10%. That's, don't get me wrong, that's all good. It's all good. That doesn't justify me paying 48 times earnings for it. And this is a collective thing as well. Because, Costco last year, this time a year ago, Costco was trading at about 50 times earnings. And you see here that we go from 30 in 2016, 25, 32, 35, 38, 39, 40. We're creeping up. And eventually people tap out. Eventually people do the Roberto Duran and they say, no mas. I can't pay 50 times earnings for this. Don't care how good it is. And I think that's actually what's frustrated a lot of investors over the past 12 months is like they own businesses like Costco, which are good businesses. And they're like, well, this has gone nowhere, but all the AI stuff keeps going up. It's like, well, yes, because the growth in the AI stuff is there. And a company like Nvidia can probably justify 50 times earnings. But the fact is, Costco today is more expensive than Microsoft. It's double the price of Meta if we're looking at an earnings basis. Google's received a ton of hype lately. Oh, Costco's a lot more expensive than Google. What about Amazon? Amazon's done nothing. Oh, Amazon's cheaper than Costco. And so if I'm an investor, I have to have Costco beat all of these other companies for it to be a good investment decision for me. And when a company gets to the point where like it's trading at 50 times earnings and it's offering single digit growth, like that's just not enough. And eventually people pull back and the price reverts. And we got same issues over at Walmart. Walmart's done pretty well year to date. It's up 27%. But let's look 5 years. Oh, bloody hell. It's done a lot better than I thought. I wouldn't buy Walmart today at 40 times earnings, though. It's a lot of money. Has Walmart outperformed SPY, though, over the past 5 years? Has it? It has. Good for Walmart. But at some point, you got to say no. Does that make sense? Give me a 4 in the chat if that makes sense. And this has nothing to do with how good Costco or Walmart is as a business. They're very, very good businesses. But you can't just pay whatever for them. Great example here. I got a great example. Because yesterday was a wonderful day for Cisco. Oh no, they've dropped since then. It was a great day for Cisco yesterday. Does anyone know why yesterday was a great day for Cisco? This is something I thought might not happen in my lifetime. So Cisco's had a good year. It's been a good year for Cisco. They're up 33%. They've had a pretty good 5 years. They've almost matched the market. And yesterday, they actually surpassed the stock price that they hit at the tippity top of the market in March of 2000. So if we're talking, okay, here's why you can't just pay whatever price. If you'd have paid whatever price for Cisco, March of 2000, 25 years it would have taken you to recover that. And I don't often like talking about things like this because it's cherry picking. It's not particularly helpful. But I do think it is useful and illustrative sometimes in the context of valuation. We talk Microsoft as well, great example. We talked through this a bit more in CGM a few weeks ago. Microsoft's chart looks amazing. This looks fantastic, right? However, let's do all time. Let's do December 99 to December 2014. 15-year period underwater. And the thing is, like, the company wasn't doing awful in this 15-year period. Don't get me wrong, they had some mistakes. Still got my Zune. Shout out to Zune. Shout out to the Windows Phone. But like, the company didn't fundamentally collapse in 15 years. But it didn't justify an insane valuation either. So you lost 15 years. And as John says, no, that's not even accounting for inflation. Sterling says, I loved my Zune. You were definitely one of the 7 people who loved the Zune. I guarantee that. The iPhone will never work, though, according to Steve Ballmer. But I think Steve Ballmer gets a bit of a rough go of it. Like, he inherited the company when the price was through the roof. And then Satya came in. He inherited the company in 2014 when everything was on the floor. So Satya probably gets too much credit and Steve Ballmer gets too much stick, even though Satya deserves the credit and Ballmer deserves the stick. But it's too extreme on both ends. But I hope that makes sense for everyone here. Let's take a look at some stuff. Are we enjoying this? Give me a 1 in the chat if you're enjoying this. Fantastic. I want to give a shout out to some people here. Rohit, Luis, John, Bob, Helen, always, Sterling, Wen, Rick. I want to give a shout out to Rick for saying that I should do more of these. We'll do one every month. These are fun. I like doing these. It's a chance to hang out, look at some stuff. Especially because, you know, we've got another few weeks until the next cohort of Options Cash Flow Accelerator starts. That begins on January 14th. So if you're interested, I'll be sending out an email with more information. John says, how do we get a crown by our name? I think you have to talk a lot in the chat. I think that's how it works. I'll be honest, I don't know anything about these crowns or like any of this stuff. It says a bunch of people have XP. I don't know. I don't know what any of that means. I didn't even know there was like a scoring system. It's certainly nothing that I've done. Helen says, we are royalty. And as soon as you said that, your crowns disappeared. So the current leaders are BJ, MJR, Bob, and Rohit in 3rd place. You have to send them $1,000. $1,000 is only the prize for the stock picking competition in CGM. If you're not in CGM and you don't know what I'm talking about, we're having a stock picking competition. Oh, it's Bernard. Wonderful. So yeah, we're having a stock picking competition in CGM. Everyone's submitting one long and one short idea for 2026, and the best performing combination wins $1,000, which is going to be a lot of fun. I have decided my long position. The short position is down to 2 names, but they're in very different industries. So I'm still debating which one I'm going to go for. One, I think, has more complete collapse potential, but the other probably has a higher chance of a steady decline. So I've got to weigh up the two. Because like there's a scenario where one goes down 80% next year. But there's also a scenario where it goes up. So it's like it's quite binary. But I won't say too much else because I don't want people to try and sleuth out which company it is. And the long name, no one's going to get it. No one. I can tell you, neither of them are Costco. I can tell you that much. But yeah, it's not Palantir either. It's not. I do have a small position in Palantir in my long-term portfolio. I never know what to do with Palantir. I think, it's one of those stocks where there's a cult-like following, and I've learned not to bet against that. Tesla, same deal. Like when SpaceX goes public, I'm not going to bet against SpaceX, even though there is likely going to be a period where the stock draws down 50%. But, oh yeah, I want to talk about the SpaceX IPO actually. So if you don't know, Bloomberg report came out on Tuesday, I believe, that SpaceX is preparing to go public either late next year or early 2027. They would be trying to raise $30 billion, which would be the largest IPO ever. But more importantly, they will be raising that money at a valuation of $1.5 trillion, which would make them the 1, 2, 3, 4, 5, 6, 7, depending on the day, either the 9th or the 10th largest company in the world on day one. And that's assuming the stock doesn't jump. I think the stock would jump. I think it would probably go to 2.5 trillion on day one, which would make it the 5th largest company on the planet. The level of hysteria around a SpaceX IPO would be unlike anything we've seen. And I know what you're thinking. Oh, if I just buy it at 1.5 trillion, then that's an easy 50%. 50% in a day. Bish, bash, bosh. Unfortunately, it doesn't work like that because you're not the one buying at 1.5 trillion. You're the one buying at 2.5 trillion because it's already up 60% before you can buy it. Anyone who knows anything about IPOs will know you don't get to buy the stock at 9:30 a.m. Eastern at the IPO price. You get to buy it when it magically appears on the exchange at 1 p.m. and it's already up 60% on the day. The other thing is the company won't go public if there's any sign of weakness in the market. The company will go public if we have another year like we've had this year. So the SPY is up, what, 17%, 16% this year? 17.2% this year. What? No, no, that's not what I wanted to do. Oh, for God's sake. Oh, now I'm on the wrong bloody webcam. Oh, kill me. Right, we're going old school now. There we go. Hello, everyone. Daniel says, "Nice Sammy." There's no Sammy in my room. Hello, everyone. We're back. What I was saying was, before I was so rudely interrupted, I'll do the SpaceX thing again, and then we'll wrap up. So, SpaceX going to go public at 1.5 trillion, which would be the largest IPO ever. However, I think it would jump at least 50% on day one. And by the time us plebeians are able to buy it from our interactive brokers accounts, it will be valued at about 2.5 trillion. And so I ain't touching the thing on day one, but when we get the inevitable retracement, which always happens as night follows day within a year of the IPO, then I will most likely take a position, because I've learned you don't bet against Elon. It's a very simple investment strategy and it works very well. Also, as like a tangential thing, you don't bet against companies with cult-like followings. Just ask anyone who bet against Apple in the past 15 years. No, don't say no sound. No, we're not doing that again. Is it really? Ah, wonderful. Wonderful. Who said nice Sammy? I'm like looking around to see if Jasper's in my room. But he's not. Don't bet against cults. Don't bet against any company that has a fervent following. Ah, the picture. Thank you. You know, Apple, Tesla, Palantir. To be honest, even the people who tried to bet against GameStop during peak meme mania, they're the ones who got burned. Like, I ain't adding GameStop to my portfolio anytime soon. But if the stock ever starts running again, I wouldn't bet against it either. I've learned my lesson. People can stay irrational longer than you can stay solvent. Thank you, Helen. I appreciate that. You've all got time, by the way, to get a copy of Investing for Kids before Christmas. It's only December 11th. If you need a gift for the young'uns in your life, kids, grandkids, nieces, nephews, whoever it may be, Helen, I wanted to get it out before Christmas. I don't think I'm going to do it now because I am waiting on the formatting to be finished. So it will likely get released. I don't like releasing things in January, so probably like February or March time, but it'll be ready for next Christmas. Also, can you tell your daughter to send me the invoice? I'd like to give her some money, please. And she still hasn't sent it to me. But yeah, Investing for Kids. Get your copy, available on Amazon and all other good bookstores. What else have I got to say? Options Cash Flow Accelerator Cohort 15 begins on January the 14th. Those of you already in the program, the call link has been updated, so you will automatically be eligible to join us. Those of you who are not, I'll be sending out more details on how to join shortly after Christmas. Just want to see if there's anything else that I have missed. I don't think so. But as always, thank you very much, everyone, for coming here. We will, now I know how to fix the sound issue, we will continue on YouTube. And we will be back in the new year. I will probably do another one of these first or second week of January. And thanks very much for coming. Have a fantastic rest of your day. Those of you in CGM, we have a call on Tuesday doing a deep dive on Amazon. Those of you in OCA, we will get rock and rolling on the 14th of January 2026. If I don't speak to you before then, have a happy Christmas and a happy New Year. And then I'll see you all on the next one. Take care, everyone. Good night and God bless. Bye-bye now.